Hey guys, this is Chris Mincola with the Mincola Group over at West USA Realty, and I'm doing our weekly market update. Oh, forgot my little light here. Okay, here we go. All right, that's a little bit better. Um, I am going to jump right in. I hope you all had a great Thanksgiving. I'm going to kind of jump right into what we're talking about this week. Before the holiday, during holiday season, you got to kind of take some things for a grain of salt, and you also have to kind of understand that there are certain things that just happen seasonally, pretty typically. The Phoenix housing market right now was kind of the worst that we've seen in the last 14 years, according to the Cromford Market Index. So since 2010, as far it is as it is for sellers. Okay, are homes still selling? Yeah, they're selling. Are people still buying homes? Yep, they're still buying homes, but mostly it's been pretty low numbers for the number of sales. However, prices still are gradually going up because of the low inventory. So that you can kind of look at things in those two ways. So we have um, the let me just get this out of here. Okay. So we have active listings, been increasing right up until Thanksgiving. And then we saw a little drop off, which I'll show you kind of where we are on that here in just a second. Nationally, 54% of the 200 largest housing markets are seeing inventory levels above pre-pandemic levels, indicating a broader trend of increased housing inventory. Okay, so buyer market right now, is where we're at across the country. We're in a buyer's market, is what we're seeing emerging. Nothing, not crazy, but a slight advantage to the buyers across the country. Now, also keep in mind, most of the inventory, when we talk about the inventory across the country, most of the inventory is, 40% of it anyway, is coming out of Texas and Florida. They have their own issues. But for the Phoenix area, we were seeing an increase in our our inventory up until Thanksgiving. So uh, the uh, the levels that we're seeing were pre-pandemic, and indicate a broader trend of increased housing inventory. Okay, buyer market is where we're at right now in the Phoenix area and across the country, especially in Phoenix, Pittsburgh, and Louisville. Um, those are some of the top buyers markets right now. Again, nothing insane, where people are giving things away or people are losing their market share or equity or things like that. People have tons of equity. Majority of people who own their home, well, I shouldn't say the majority, but about 42% own their homes outright, which is a huge number. Um, Mortgage rates have been hovering around 7%. That's been the issue. Even when we get these little dips and stuff, they don't last that long. We did have more of a dip over the last week or two after the election. So that's been great. Home price trends historically in December and January. These are the best months historically, anyway, for home buyers, as home prices typically dip a little bit, or there's a little bit more negotiating power for buy down rates and things like that. So, when we're talking about the Phoenix area, we've kind of given you the trend there on the contract ratios and everything, which I'm going to dig more into that. But basically, we've seen our contract ratio, right now it's about 30. So what that means is, once you get to 30 or below for contract ratios, that's active and under contract ratio. So not enough properties or more properties being active than under contract in that ratio, then you're in a colder market. And once you hit 30 or lower on that contract ratio. So, um, you know, as far as, hot areas or even warm areas, there really aren't any in the Phoenix area. Areas, we previously had marked as hot. Parts of like this, like Tolleson and Glendale, they've even cooled down. And there is a significant shift towards a broader, colder market. So market conditions right now in December tend to be slower months, of course. Anyway, you've got fewer buyers, more inventory that was piling up until recently. We've seen a little bit of dip. We'll see if that continues. is showing a buyer advantage though. So, right now, typically during this time of year, it's better for buyers, but overall, we're seeing even a little bit better trend for buyers because they have a little bit more inventory that they could choose from. Things are moving a little bit slower. A lot of that has to do with rates and affordability, of course. Like I said before, there's about 4 million people who just have been sitting on the sideline for about 2 years, 3 years because they either couldn't make it with all the competition that we had back in 2021 and the end of 2020 and beginning of 2022, right up until about April, May of 2022 till now. Affordability has been a problem for them because interest rates pretty much, we saw them pretty much double, almost triple, to the point to where, prices double in most areas of Phoenix. So it was really an affordability issue for a lot of people, and for across the country, that meant about 4 million people have been sitting on the sideline. So there is pent up demand of people who want to buy. Now, a lot of those people that have been sitting on the sidelines, a lot of them are first time home buyers, even though we've seen a lot of people get involved in new homes because of all the incentives that they're giving right now. I mean, I came across a deal this week. I've been trying to tell people about it, and hey, it's up to them if they want to or not. When you're renting, though, you're just not getting any equity. That's 100% interest when you're renting. And in some circumstances, it certainly makes sense to rent. If you're only going to be in an area for a short period of time or whatever, I'm not saying there's no reason why someone might not rent or they just can't qualify. That may be another reason. But, in a lot of rental situations right now, you're having to almost be at the same level for credit and income almost than you do when they figure out if you qualify or not, than you do when you're going to buy a house. Not to mention, that although the rental market's cooled quite a bit, and leveled off, it's still not inexpensive. I mean, the average property in the valley right now is about 2,300 a month for the average rental, off the MLS. So, and not all rentals are on the MLS. I get that too, but that's just kind of the trend that we're seeing there. But anyway, I've seen deals. Yeah, a lot of people ask me about down payment assistance program. I mean, there's literally probably 45 different down payment assistance programs. The issue usually is that the fees or the rates, however you want to put it, are typically higher. So they're giving you all that money up front, whether it's a grant or a second mortgage. Maybe you can't sell for a few years the way the structure of the loan is on the property and all that. But builders are giving right now incentives that are insane because they're doing. I've got a builder that's doing zero down, zero closing, with usually, again, rates are usually higher, and the average rate has been hovering around 7. It's been lower this week. It's in the mid sixes now, but the average rate on that particular program with that particular builder, not forever, temporarily, over the next, maybe a couple of weeks at the most, is right now running at 5.5%. Some, they're able to get some people in at 5.25, all the way up to 5.75, but that's still smoking the other down payment assistance programs out there that I'm aware of that I've seen. And I usually try to really keep up on this sort of thing. And a lot of builders are offering a lot of incentives. Now, if you're VA, that's great. You can get the zero down. They'll pay your closing costs as long as you go through the lender with the builder and all that. And you can usually get a better rate as a VA. VA loans are great, plus no mortgage insurance and all that. But when you're looking at the new home market, it's been kind of its own animal. It usually is kind of its own animal compared to the resale market. First of all, new homes are your real new inventory, and they're also able to give more incentives typically than maybe on a resale home might do. But we're seeing a huge number of people giving concessions, and I'll dig more into that here in a second and what we're doing on pricing. But market conditions right now definitely tends to be slower this time of year anyway. And with the affordability issue, it just kind of compounds that a bit. But the inventory definitely dipped because of Thanksgiving. It's unclear if that'll continue. We'll keep an eye on that. Again, this time of year, you kind of, you have your cycles and you kind of take some things with a grain of salt because it is the holiday season, right? So it's not really the greatest indicator of things always, because, it can kind of it kind of fluctuate a little bit, and things definitely just slow down in general anyway. But if you were to look at a chart, and I've shown it before, where it just kind of this time of year, it just kind of everything just drops off, right? Um, but those buyers that are out there are serious, and so are the sellers. But usually, the a little bit of advantage to the buyers this time of year, especially right now with the way the climate is. So mortgage rates have stabilized this week, right around 6.6%, which is great on the average across the country. Yes, you can get lower, and you can get all the buy down programs and deals and stuff, as long as you got the right agent negotiating and knowing what's out there. Um, so we're definitely in a buyer's market. There's different areas in the Phoenix metro area that may vary a little bit, but the Fountain Hills, Scottsdale, they're still technically in seller's market. Nothing, that's a huge advantage to sellers at all. But those areas, definitely do have a little advantage. The market is expected to remain, slow through the holidays. And we'll kind of keep you up to speed on what's going on with that. Now, um, I'm going to share my screen. I just wanted to kind of get some of that stuff out there for you, because let's start off here. I've got the jobs report came out this Friday. That's why I wanted to wait, and then I got slammed with work and stuff. But payrolls increased 227,000 in November, more than expected. Unemployment rate at 4.2%. But the bottom line is the unemployment rate edged higher to 4.2 as expected. Job gains were focused on these areas of leisure, healthcare, and government, which government, never a good thing to really gain in necessarily. Traders accelerated their best on interest rate cut this month following the payroll. So we're probably going to see a 25 basis point cut this month from the Fed. Nothing crazy, nothing out of the ordinary, nothing that we didn't think, was going to happen there. But, what we saw is the participation rate has definitely not been the greatest in the housing market. So we see a lot of people, once again, as we've talked about, there's softening in the market, but it hasn't broken yet. What would broken mean? It would mean that, if we were at 4.3 to 4.4 in unemployment, we see the labor market starting to get towards the direction of breaking. And 300, if we were at 323,000, unemployment or jobless claims come in, that would be a big indicator. So, but the unemployment rate edged higher to 4.2 as expected. Jobless figure rose as the labor force participation rate nudged lower, and the labor force itself declined. Now, why is this important? Because the feds have said, Jerome Powell and the Fed has said been trying to tame inflation. They were late to the party and all that. We talked about that, and a lot of that had to do, of course, with government spending, dumb energy policies, and things like that. But the data, as it says here, is likely to give the Federal Reserve a green light for lower interest rates. Now, they've done a few rate cuts. It would take them a total of 6, or let's say 3 to 4 more to get to neutral policy, which still isn't going. But the bond market already priced all this in, which would basically take us from where we were all the way up at 8 down to an average across the country around 6% mortgage rate, which means that the 10-year treasury would be around 4, okay, give or take a little bit. So because there's usually about a 2-point swing between the 10-year treasury, and they have the slow dance, as it's called, with where the mortgage rates are at. So, but the bond market, okay, that what drives that 10-year treasury is always going to be ahead of the Federal Reserve, and they've already priced this in. It's like, yeah, this is where it should be. The Fed's just slow and old and getting there slowly but surely on their end. And it's never a direct correlation with mortgage rates with what the Fed does. Like I said, they're behind anyway. So that's the story on the jobs numbers and why that's important, because the Federal Reserve has been trying to break the labor sector, because they figure if people have less jobs, they're going to buy less things, or if they're not getting the raises they should get, and we have a softening in the jobs market, then inflation goes down because people aren't spending as much money. That's how they look at this, and that's their way of taming inflation. And that's why they want it to cost more in order to do things like borrow money. It costs money, more money to borrow money. Businesses will not do things in their head. This is how they're thinking. Businesses will not hire people, pay them more, give them raises and bonuses, will not put into new production, new manufacturing, and all those sorts of things that drive the economy. So the Fed says here is on course to cut interest rates in December, but what happens next is anyone's guess because everybody's, oh, we're worried about Trump. Well, again, with the underpinning things that we've talked about many times, like the deregulation, the cut in government spending, the energy policies, the lowering of the tax rate, and the new Treasury person getting to a policy where they will not allow because they'll be able to buy and sell off what they need to, but the Treasury policy of the Treasury person. This is why it took a little while for Trump to President Trump to pick that person, is to never have it go above the 10-year Treasury to go above 4.5. As a matter of fact, we want it to be lower. So even if we have to pay for that, so that is the policy going forward. I'm not worried about it. I think we're easily going to see rates hover between 5.5 and the low sixes for all of next year. So let's just say, probably, most of the time hovering, especially after we get through the first quarter, right around and into the busy spring and summer season, right around 5.7 to 6, right in that range is I think where we're going to live. But if you want a kind of a wider range of the average, 5.5 next year could be all the way down to 5.5 average across the country. You can always get lower, but those are just the averages. 5.5 to, let's say, low sixes, 6.25. That's where I think it's going to live. I also think, because of that, and just because we've already seen after the election, things happen like, this talks about more about the mortgage rate fall more than expected, and the jobs report basically being softer, not broken yet, but softer. So that's going to give a bounce to the 10-year Treasury. And, we saw that. And where we ended up was right about there. So, it's the slowdown and then it dipped down. So we were right here with the 6 point, like I said, they always run off this 30-year fixed, which is basically your conventional. Typically, FHA is even normally lower. They're different kind of loan, mortgage insurance is involved, all that sort of thing. So, for more information on that, please let me know. We'll connect you with the right person and help you through that. Home mortgage applications. So this is what I wanted to get at over the last week or so. We have seen an increase, or in the previous week, of 12.43% in mortgage application data. So what does that mean? Well, rates took a little bit of a drop after the election. A lot of people were waiting till after the election. They saw rates are dropping on top of that. So people are starting to apply. Now, how much of that will be immediate? Are they going to get out there and shop right now? I think we have seen an uptick in activity. That's just my opinion on the street. But this is the indicator that we look at for about the next, looking forward for the next 30 to 90 days. What is the application data? Then we'll want to look at what is the actual, after that, what is the actual purchase data? So we'll keep an eye on that. That's why we track this stuff every week. Mortgage purchase demand continues surging. Okay, so we're seeing, like I just said, a surge there, and we're going to keep an eye on that. Okay, so we want to make sure that we watch these things because it takes time for people to go out and then start looking at homes, then go under contract, and your usual escrow period, if you're doing a home loan, is typical home loan is going to be about, could be 3 weeks to 4 weeks, but usually let's say 30 days. Okay. Let's just say 30 days. Some may take a little bit longer it may take 45, but let's just say 30 days on average. So right now, here's our active inventory. Um, so anyway, this is why we say, look, this gives us that outlook for 30 to 90 days though, with that going up. So we saw a little bit of a slight downturn in the amount of inventory with Thanksgiving. Um, it's going to ebb and flow a little bit this time of year. Again, you got to kind of keep it with a grain of salt. But here are average days closed on market's actually gone down a little bit at 68. That was in the 70s. Average days closed on market at 68. Again, a lot of people were waiting for the election. A lot of people were like, if it goes one way, I don't know what's going to happen. But if it goes this way, I'm not worried. And that's kind of what we're seeing, with this application data. And then rates drop a little bit, so that's going to only add to that. So that should continue surging. Again, with the holiday, Christmas, New Year's, things could really kind of slow down a little bit. So again, take it with a grain of salt. But 4.23 month supply, it's going to put us in a balanced market. Balance is usually going to be about 4 to 6 months in today's internet age and the way things are, move a little bit quicker. It used to be about 5 to 7 months back in the day prior to the internet and all that. Absorption rates, 23.63%. That is not bad. One of the other things too, I wanted to mention to you before I get too far over my skis here is, well, hang on a second. I'll bring you back to that. So average list price is 766,000 and some change. Average sales price 560. Again, a lot of that has to do with the extra inventory taken as a whole for the greater Phoenix area at 560. The list of sales price data, though, gives us an idea of what's going on. People are maybe shooting for the moon, especially this time of year with the way the market has been up until the election. They're at 97.81. They're listing, whatever they're listing at, it's basically a little over 2% lower is what they're actually getting. And what we usually like to say is a healthy number there is just over 98 on that, just over 98, like 98.2 or, in that range is usually pretty healthy. So we're not too far off with that, but a little bit lower because people are, paying out concessions, maybe getting some price reductions this year and all that. Now, active inventory is down a little bit, like we said, with the last week, non-under contract or pending. Pending's been down. I think we're going to see that start to go up. Again, with Christmas, you never know, but definitely into the new year, there's no doubt number's going to go up, of course, is seasonally. And then if we have lower rates, we're past the election, all that. Closed units, 11.4. So that number was way up. Now look at the distressed closed and look at the distressed over here, short sale, lender owned REOs, all that. You can't just look at the percentages because we're just like, oh, look, short sales are up 53%. So that means there was 20 closings. So that's not in reality. Again, nothing to get worried about as far as a crash, foreclosures, all that kind of nonsense that we hear on the mainstream media, okay, or legacy media. 66.16 of the entire inventory is under 600,000. The rest, up to $1 million, is a little over 20%, and then $1 million plus 13.4. Again, this is just in the greater Phoenix area. So again, that the flood in the market definitely indicates, this number here being, affected by that. So, one other thing to bring you to next is this Cromford Market Index, which we always talk about. We are in a buyer's market because below 90 is buyer market, over 110 is seller market. In the middle, 100 being completely balanced. If supply and demand numbers here are the same, that means we're in a balanced market. 86.8 definitely puts us in a buyer's market. 89 here on the gauge, so that means we're 11 points lower than 100 on supply, where we should be. And for demand, we are at 77.2. So basically, we're 23 points lower than 100. Now, the market has only been this favorable for buyers in the Phoenix area 3 times over the last 24 years. This is from Cromford. And that was 2006 to 2008 for those 3 years during that period. 2010 for 16 weeks in 2010, 2022 for 4 weeks, and 2024 so far for 3 weeks. So that's the only time the market's really in the greater Phoenix area since they've been tracking this that we've seen an advantage to buyers. So take that for what you will. And I mentioned this earlier, but our contract ratios, this kind of tells us even more than this chart here. This tells us the now, like what is happening this week right now. And, this is our latest data that we have. So I'm bringing that to you. And the contract ratios kind of tell you the story at 30. So we're cold under contract versus active listings. Okay. So 30 and below, cold. We're overall in a cold. Here's kind of a look at the map of the greater Phoenix area. And, here's the color coded hot. Hot would be, these other areas in here right now. We're seeing, the contract ratio at 65. Glendale is at 67. So those are a little bit hotter areas. Um, Everything else is kind of just like, kind of, in that warm balance or cold range. Okay. So anyway, there's a story on that. And we have Chandler, Fountain Hills, Scottsdale, Phoenix, Avondale, and Cave Creek. Those are in sellers markets, barely in sellers markets. We have Glendale, Tempe, Paradise Valley, Gilbert, Mesa, and Peoria. Those are all in balance range of the Cromford Market Index. And Surprise, Goodyear, Queen Creek, Maricopa City, and Buckeye. Those are all in buyers markets, specifically in buyers markets. So, guys, if you have any other questions on any of this stuff, you're not quite sure, maybe what some of this means, you want more information about what your property's worth, you want to know how to get started on buying a property or getting started to sell and buy a property, or you want to get involved in investing, please let me know. We can help you with all of that. We even can, set you up with land deals, whatever it is that you're interested in when it comes to real estate. Let us know. My wife Cynthia and I work as a team, and our son is also a mortgage broker, so he can shop the best rates for you. If you have any questions at all, kind of a one-stop shop for everything. So we'll talk to you guys next time, and stay safe out there. Let us know if you need anything at all. Happy to help.